So you're sitting in the finance office. You've already agreed on the car. You've already agreed on the loan. Now a new guy walks in. He slides a folder across the desk. He starts talking fast about two things you've probably never thought about in your life: gap insurance and an extended warranty. He makes it sound responsible. Skip it, and it almost feels like you're driving off the lot naked, uninsured, one pothole away from disaster. Here's the thing. Both of these products are real. Both of them protect against a real risk. And both of them, sold the way they're usually sold, are one of the most profitable moments in the entire car buying process. Profitable for the dealership, not for you.
No!
To understand why, we need a caveman. Not literally, but there's a useful trick here. Strip every financial product down to its caveman version. Find the one sentence, no jargon truth of what's actually happening. Do that, and the whole finance office suddenly makes a lot more sense. Caveman say, man pay money now, so man not pay bigger money later if bad thing happen. That's it. That's insurance. That's a warranty. That's basically every financial product ever invented for a car. The entire game is deciding whether the bad thing is likely enough and expensive enough that today's payment is worth it. Everything else is decoration. The sales pitch, the pressure, the bundling, the fine print, all of it sits on top of that one sentence. Let's start with GAP. GAP stands for Guaranteed Asset Protection. The risk it covers is oddly specific. A new car loses value the moment it leaves the lot. It keeps losing value faster than most loans get paid down in the first year or two. So if your car gets totaled or stolen early in the loan, there's a real chance your insurance payout comes in lower than what you still owe the bank. Insurance pays based on the car's current value, not what you paid for it. That leftover balance is the gap. Without coverage, you're on the hook for it, out of pocket, on a car you no longer even have. Caveman say, car break, insurance pay for broken car. Banks still want more money than broken car worth. Gap pay that leftover. That's a real risk. For certain buyers, long loans, small down payments, cars that depreciate fast, it's worth taking seriously. The problem was never that gap exists. The problem is what happens to the price the moment it walks through the finance office door. Here's where the story gets interesting. Gap isn't one product with one price. It's the same coverage sold through two completely different channels, and the price gap between them is enormous. Buy Gap as an endorsement on your existing auto insurance policy, and you're typically looking at $20 to $100 a year. Some insurers price it as low as a few dollars a month. It rides on your existing policy. No separate contract, no separate paperwork. Buy the exact same protection at the dealership, and the price transforms. Dealers and lenders typically charge it as a flat fee, somewhere between $400 and $700. Plenty of buyers report paying more. One commercial insurance broker documented a client quoted $800 per vehicle by a dealership for coverage that would have cost about $69 a year through a fleet insurer. That's a markup of over 1,000%. Caveman say, same rock, one man sell rock for 1 coin. Other man sell same rock for 10 coin. Buyer not check price of rock first. And it isn't just the sticker price that hurts. Dealership gap almost never gets paid for up front. It gets rolled into the auto loan itself. That means you're now paying interest on insurance for years. One breakdown from an insurance industry writer laid out the math on a dealership gap policy priced at $895, financed over 6 years at 7.5% interest. By the time the loan is paid off, the buyer is handed over roughly $1,100. The same protection bought through their own insurer over the same 6 years would have cost about $600 total. Same protection, just under $500 evaporated into the financing structure. Why does the dealership price look nothing like the insurance company price? Because at the dealership, Gap isn't really being sold as insurance. It's being sold as an add-on. Same category as fabric protection or a paint sealant. and it's pitched at the exact moment a buyer is mentally exhausted from negotiating the car itself, and least equipped to negotiate one more thing. This is where we need to zoom out and ask an uncomfortable question. How is a markup that large even possible? The answer isn't hidden. Federal regulators have already put a number on it. In December 2024, the Federal Trade Commission reached a $20 million settlement with Leader Automotive Group. The investigation behind it found that add-on products like gap and extended service contracts carried profit margins above 99%. The FTC also found that salespeople earned bigger commissions selling these add-ons than they earned selling the car itself. Caveman say, man sell car, get small piece of meat. Man sell paper, get whole animal. Read that twice. It explains almost everything about how the finance office pitch is built. If a salesperson makes more money convincing you to buy a $700 add-on than they make selling you a $35,000 car, guess which conversation they're going to be better at? And regulators have found that some dealers didn't stop at high prices. They misrepresented whether the product was optional at all. A joint FTC and Connecticut Attorney General lawsuit against one dealership alleged that staff falsely told consumers gap insurance was required to finance or lease the vehicle. Federal rules make clear it never is. The Consumer Financial Protection Bureau states it outright. Gap insurance cannot be a condition of getting your loan approved. It is always optional. Dealers are legally required to treat it that way, whether or not they say so out loud. There's a second failure mode that has nothing to do with price. It's arguably worse because it doesn't show up until the exact moment you need the coverage most. Some buyers have paid for a gap policy at the dealership, signed the paperwork, and driven off. Later, they discovered the dealership never actually forwarded the premium to the insurance company. The policy they were charged for was never truly in force. When a claim comes in after an accident, there's no coverage to pay it. The buyer is left facing the deficiency balance directly, sometimes pursued by the lender, sometimes sent to collections, with the dealership nowhere to be found in the paperwork trail. Consumer attorneys who handle these cases describe it as a distinct category of dispute, not a coverage disagreement. A policy that was paid for and simply never existed. Caveman say, man pay for shield, shield never built. Man find out only when spear already coming. This is why the actual protective habit isn't buy gap or don't buy gap. It's buy it from a source you can verify and confirm in writing that the policy was actually funded. A gap policy through your own insurer shows up on your own account, under your own name. You can verify it anytime you call. A gap addendum buried in dealer paperwork is only as good as whether that dealership actually processed it. Gap is a targeted, narrow bet on one specific bad outcome, a totaled car early in a loan. An extended warranty, more accurately called a vehicle service contract, is a much broader and much murkier bet. The bet is this: something expensive will break on your car after the factory warranty runs out, and paying thousands upfront now will cost you less than paying for repairs later. Here's the first thing worth knowing. Almost nobody in the finance office volunteers it. Legally, the word extended warranty is often being used incorrectly. Regulators have pointed out that only a vehicle's manufacturer can technically offer an extended warranty. Everything sold by a third party is a service contract. It's a separate legal product with its own rules, exclusions, and claims process. It just wears warranty language because that sounds more reassuring. Caveman say, names sound like promise from maker of spear. Really just promise from stranger who sell paper. The economics here follow the same logic as gap, just scaled up. The price tag is bigger and the sales pressure is longer. A widely cited teardown of one of the largest players in this industry's collapse found that on a contract typically priced above $2,000, the company's own profit was often more than $1,200. The actual coverage provider received roughly 30% of the money paid. The company financing the deal took another 10%. Run the numbers, and well over half of what the customer paid never had anything to do with covering a future repair. It was marketing, commission, and margin. Caveman say, "Man pay 2,000 coin for promise. Half that coin never go toward fixing anything. Half just go toward selling promise." Every industry has a version of the worst case story. The extended warranty world has a particularly instructive one. It shows what happens when the sales pressure stops being aggressive and starts being fraudulent. For a stretch in the 2000s, a company operating under the name US Fidelis became one of the largest sellers of vehicle service contracts in the country. It was built almost entirely on direct mail and telemarketing. The pitch leaned hard on a specific deception. Mailers were formatted to look like official notices, warning recipients that their factory warranty had expired or was about to expire. The wording implied the mail came from the manufacturer, the dealer, or even the state motor vehicle department. It came from none of them. The company backed this up with a flood of automated robocalls, dialed to essentially every phone number in a given area, home and business lines alike. The bet was simple. A small percentage of recipients would call back, believing their factory coverage really was about to lapse. Caveman say, "Stranger send smoke signal shaped like signal from chief. Man think chief calling. Chief never called." The company collapsed into bankruptcy in late 2009 as complaints piled up. The Better Business Bureau alone had logged over 1,400 complaints. 9 state attorneys general sued. They alleged the company had deceived consumers into spending thousands on contracts that, in many cases, simply didn't cover the repairs they were sold to cover. Investigators also found the company had used technology to mask caller ID, violated do not call laws, and routinely denied legitimate refund requests. In the settlement that followed, the company's co-founders agreed to surrender at least 90% of their personal assets. According to the Oregon Department of Justice's account of the case, that list included a 40,000 square foot mansion, a 50-foot yacht, and a fleet of cars, boats, and motorcycles, all purchased with the proceeds. Criminal charges followed. One co-founder was sentenced to 8 years in prison. The other got 4. Charges included insurance fraud and felony stealing. Caveman say, "Chief build big house from small coins of many men. Many men never see repair. Chief see mansion." The important lesson here isn't avoid this one company. It's long gone. The lesson is that the entire structure that made the fraud possible is still around. High commissions, aggressive outbound sales, contracts full of exclusions that buyers never read until it's time to file a claim. That's still the basic architecture of how a lot of legitimate extended warranties get sold today. The scam version was just the same machine, with the honesty removed. Here's the part that surprises people. Extended warranties don't have to be fraudulent to be a bad math problem. Consumer researchers who studied the category point to a structural truth that has nothing to do with any one company's ethics. The seller has to collect more in premiums than they pay out in repairs, or the whole business stops existing. That's not a scandal. That's how every insurance-shaped product works. But it does mean the average buyer is mathematically expected to come out behind. One writer who reviews these products for a living described buying a legitimate, non-scam extended warranty for $1,800 on a used minivan. Over the life of the contract, exactly one claim came through. A broken air conditioner covered for $900. Nothing else went wrong. Net result? $900 spent for $900 of value on a policy that could just as easily have paid out zero. Caveman say, man pay for rain dance. Sometimes rain come. Man who sell dance always eat, whether rain come or not. This creates a strange psychological trap that nobody talks about at the dealership. The only way to feel like an extended warranty worked is for your car to break down expensively enough to beat what you paid for it. You end up quietly hoping for the exact thing you're supposedly protecting yourself against. None of this happens by accident. Once you see the incentive structure, the pressure in the finance office stops feeling mysterious. Regulators found that in at least one major settlement, a salesperson's commission on the add-on outweighed the commission on the car. So the entire conversation is engineered to happen at the point of maximum buyer fatigue. After hours of negotiating, right before signing, when saying, "Let me think about it," feels like undoing everything you just agreed to. Caveman say, man tired from long hunt. Stranger offer one more spear right before man walk home. Man too tired to say no. Regulators have been closing in on exactly this dynamic. The FTC's Combating Auto Retail Scams rule and a string of settlements built around it specifically target dealers who misrepresent add-ons as mandatory, hide their true cost inside bundled monthly payments, or fail to disclose that every one of these products, gap, warranties, paint protection, all of it, is negotiable and skippable by law. Strip away the sales pitch and both products reduce back down to that same caveman sentence. Pay something now to avoid paying more later if a specific bad thing happens. The math only works in your favor under specific conditions, and those conditions rarely line up with the moment you're being asked to decide. For Gap, it earns its cost mainly if you financed a long loan with little money down on a vehicle that depreciates quickly. Even then, the coverage is close to interchangeable. The smart move is pricing it through your own insurer before ever hearing the dealership's number and confirming any dealer-sold policy was actually funded. For extended warranties, the honest version isn't a scam, but it's still a bet you're structurally likely to lose on average. It's priced to guarantee the seller a profit, whether or not your car ever breaks. It can still make sense for genuine peace of mind on an unreliable model or for a long-distance driver, but it's worth shopping the price the same way you'd shop insurance. Don't accept the first number in a folder slid across a desk at the least convenient possible moment. Caveman say, best hunter, not one who buy every shield offered. Best hunter, one who know which danger real and how much shield actually cost outside the cave. And that, in the end, is the whole story hiding behind the finance office pitch. Gap insurance and extended warranties aren't inherently dishonest products. They're ordinary risk transfer math, dressed up, marked up, and timed to land exactly when you're least equipped to do the arithmetic yourself. Do the arithmetic anywhere else. An hour earlier, a phone call to your own insurer, 5 minutes with a calculator, and the must-have folder on the desk turns back into what it always was. One option among several at a price that was never actually fixed. If this changed how you think about something you thought you already understood, that's the whole point of this channel. If you enjoyed it, drop a like and subscribe. It genuinely motivates me to keep making videos like this. And if you've got a topic you want broken down this way, drop it in the comments. I read all of them.